But today we're going to talk about a little bit of, it's interesting because it kind of, I think it means a little bit something to both of us. But at the end of the day, maybe the same thing. And John, if we can jump to the first slide, we're going to talk about mean reversion. So what is mean reversion? And walk us through this, Jermal, because it's an important aspect for, I think, for all kinds of trading when you're looking statistically at markets, which I think we all agree now to a great extent is our edge. It is one of the most important edges. So walk us through the idea of mean reversion here.
Yeah, I mean, I think it's important in a lot of different ways, to be honest with you, right? Like, I mean, we can look at this in so many ways, and we're going to look at it from the trading aspect, but I know we got some slides ahead to where we can touch on that. But just from this standpoint of there's a mean of everything, right? Like, this is the way I look at it. There's a sort of mean, or, you know, and I'm kind of not a nitpicky person. So I always find this funny when we make this differentiation between mean and median and average. I know that there's an actual difference, but whatever, dude. Like, at the end of the day, where is something kind of really considered to be fairly valued? And you can really take this in a lot of different ways. Like, you can say, where's the fair value of it, or mean of it, or where's the average? And then I feel like you always have to add a time component to it, right? Because you can't just say, well, I think this is the mean. What does that exactly mean? Does that mean it's the mean over the past year, or the past 30 years, or the past month, right? And so I think that's kind of what we're going to get into today. But when I see mean reversion, I always think like there's an average or a mean of something, and eventually something is either going to be way above or way below. Where is it eventually going to lie, right? So what's the mean of, for NBA players right now? What's the mean salary? Right. And there's some people that are way above and way below. Of course, we always look at what's the minimum, right? Like the league minimum for baseball, for basketball, for,
that's a
hockey,
great analogy. Right.
Right. But what's the mean? Right. And so I think that's the way I always look at it. I mean, in general, like, what's the mean for our relationship with you and me and Frank? I make fun of Frank a lot. Right. And so, at some point, I'm going to deviate from that mean, and I'm going to be nice to Frank, and I'm going to make fun of Pete. There's a mean there. Where's the mean going to revert to? So eventually the mean is always going to revert to me making fun of Frank, and on the last slide that we have in here. But that's the way I look at it. And
if we do make fun of Frank, we just have to shrink down this bell curve a little bit. So
well, I mean, at some point, whether I'm making fun of Frank or whether I'm making fun of Pete, there's sort of a mean reversion. Where do we come into on mean reversion? So that's the way I always look at it. I mean, how is that about sum it up for you? What do you think?
Same thing for you. Same thing for me. This idea of normal is not the right word. And I think mean is the perfect. And it's funny because you mentioned the difference between mean, median, mode. We learned all these things. Yeah. They're really, statistically, this is the interesting part of the discussion. And the largest set of occurrences, where does that market lie? And with the proclivity, like almost everything we do has this. It's funny because I was going through this morning. I was thinking about all the mean reverting things of behavior that I do during the day that are interesting. And I think this idea of mean reversion is a really important, especially in the markets we're looking at, of the tendencies for markets, like so many other different parts of our existence, tend to work. And I think the idea of this, for me, the challenge always is there's two sides to this. The mean reversion piece, which makes perfect sense. The time frame, that's always my challenge is, and you mentioned that early on, and you're right. You can look at, see two very different sets of numbers depending on the time frame you use. So what is the relevant time frame? I think that's always an interesting exercise in terms of finding what works. And I think that's a function of what you're trying to accomplish, I think, trading wise. And John, let's jump slide ahead if we can.
I got a perfect example right now too, because I play a lot of fantasy sports right now. Of course, the main sport is fantasy baseball. I had no idea. I kind of knew a little bit, but I had no idea that Kyle Schwarber is mashing the way he is right now. I don't know if you've seen it, but like this dude has hit like 15 home runs in like the last like 2 weeks or something like that. Like,
really? Wow.
Yeah, he's like on like Barry Bonds, Mark McGuire type pace, which of course has people asking questions. But
right. Where's the cork and where's the juice? Yeah,
you know what
poor
I mean?
guy, and it stinks. I know.
And so, of course, right now he's hot, and so at some point he's going to have to revert to the mean. I mean, you would assume if he doesn't, well, then they're going to be checking him. So we'll see what happens.
And that's the perfect example too of, we look statistically at outside days and the likelihood of how many outside days from that one standard deviation we can have. Is it 4? And we know the percentage shrinks when it's 5 or 6, but we've seen these all moved in so many ways. But something that is key in different ways to all of us, I think, in terms, because VIX is a tool not only for a mere reflection of equity index volatility, it is kind of a cousin, brother, whatever you want to call it, to almost every other market we trade. So when you look at VIX and you talk about reversion, how do you put this into your thought process, Jerome?
So the way VIX works, as we always talk about, I mean, VIX is a forward-looking measure, right? Like it's a 30-day forward-looking measure of volatility. And oftentimes, we compare it to its mean, which we often consider like 19, like that long-term average of VIX. And again, it's all about time frames. Like when you say long-term average, I think, I don't remember the exact year. You probably remember, Pete, but like, I think it's like 95 I don't remember where. So of course, VIX is calculated using the S&P 500. Right. Once upon a time, it was calculated using the OEX, which was the S&P 100. I don't remember where I think it was 2004, maybe we differentiate. I don't remember. I don't even care. I don't have to remember anymore. That's the best thing about it. But let's just say long-term average of VIX is 19. Of course, we were well above that, as we see on this chart here last year. And you may have, looked at this and if you cut it off and say, okay, starting at 40, I'm going to get short VIX, right? And of course, you took an L for a while there for at least a solid, month or so, right? Because of what happened. But that happens at times when we're trying to time when something's going to revert to the mean. That can happen at times, right? And so I guess, as I'm foreshadowing like a question I'm going to get to you, how do we determine that? I mean, and I'll give you that floor in a little bit, but I think a lot of times with volatility, when we're doing with options, I mean, you don't know. Like often, of course, when something is I don't know, not imploding, but it kind of exploding and vol is getting higher. How do you determine, when not to keep selling or usually the move kind of makes you determine, because as the vol is getting higher, that means it's going to move more, right? And so say, vol gets high, you say, I'm selling a condor here. You got to go really wide on your strikes. Because if you're close, of course, you're going to get beat by the move as well. So it's a tricky thing, naturally. And usually, again, I just want to reiterate that, like that idea of implied volatility getting higher means we're going to see more movement as well. I mean, that's essentially what that means. But eventually it will return to a mean. It's just a matter of when that happens. So I always wonder, and I guess this is maybe foreshadowing, but how do you determine, the difference with mean reversion or what mean reversion is for any given product that you may trade futures wise?
Well, it's a great point, because for so long, all we had was price. We couldn't trade volt. I should say we could trade VIX, but in the world of futures, options on futures are a relatively new concept. So we had to look at reversion differently. And I love the fact that you pointed out that reversion may give you a bias in terms of where we are and where we've been, but the mechanics change. And you spoke to that very eloquently about how you're widening out your iron condor because of the expanded volatility, and its nominal level is going to compel you to give yourself, there's going to be more movement. So you're going to have to give yourself a wider range to be successful. And I think that in and of itself is an important takeaway from the fact that we're moving away from the mean. So if we jump one ahead, we can look at products to the same extent, a little bit differently. John, we're going to jump. Thanks so much. Interest rates, they also tend to exhibit mean reverting behavior. Now we're looking at our smallest tens right now, and it is pegged right at 1495. We can't get closer to 1500. Well, we can, 5 points closer, but we are definitely there. And this is definitely, when we go back and we look at that time frame, we look at that I want to call it a more reasonable time frame. I tend to not look at, I don't know, and I'm curious. I tend to not look at means and numbers that go out 10 years, 12 years, because it seems to be there's so many other pieces that may drive that change that the numbers, it's the statistical aspect of it gets overwhelmed by those. So I think that sweet spot we talk about from 3 months to 6 months is maybe up to a year, depending on your strategy, is really where we want to be here. And here we're looking at a little bit under a year, but interest rates, we could see the same thing too. And much more so, I think, because they truly are neutral. I look at equities, and equities tend to have whether it's the dividends or whatever, there's a little bit of upward bias. There's a natural upward bias to them. You look at something like an interest rate, there really is no, it's a neutral security. There is no upward or downside drift, not bias or drift. So these make for great mean reverting trades. Now, if we had looked at this 6 years ago, we would have said, well, mean reverting should be that the 3% is low and the 6% is high. We know that's not the case here. So that's why we put realistic expectations around. But the same thing here goes into trading strategy. When we move away from that mean, it's usually because we're getting bigger moves, added uncertainty, just like you see in the expansion in the VIX. So we're giving ourselves more room, but we're looking for that play back into that normalized range. So it's interesting. We both use the same set of, not the same set, but similar sets of mechanics to let ourselves participate in that higher volatility, larger divergence as the market moves back into that mean. But that becomes a very important part of our strategy. I would never say it is my sole determinant of strategy, but it's an important one when we see that consistency of mean around a range and the divergence from it. So two very different ways to look at it, one through volatility, one through price. But I think the takeaways in terms of the way we use it are very similar. I find that fascinating. That's really a great takeaway for us, Jermal.
Yeah, and you touched on one thing that I gotta bring up here, because this is pretty funny actually, because what you said was so great. The idea of like there's not this drift and you don't look over, long terms to say, this is the mean, because there's so many different factors that are affecting it, right? And like right now, there's different factors affecting the 10-year than there was 10 years ago, kind of like exactly what you said. Same thing with volatility. I mean, and in an interesting way, but in the same wrapper, this convo, but to explain it, I have to say this because there was this guy that me and some other Twitter friends, because they're definitely Twitter friends, where we were making fun of this other guy on Twitter because he was talking about VIX. And again, people should understand, like when we're talking about this mean reversion, this type of behavior, it's not technicals. It's not like a technical situation. And so, you can't use like technicals on something like the VIX, because at the end of the day, the VIX is telling you what to expect in daily moves in the S&P 500. So technicals don't mean a damn thing on the VIX. Like people should understand that, like not at all. And so right now we're at a situation where let's just say, VIX is like, I don't know, 15 and change. So it's really, let's say 16. 16 means we're charting 1.5%, 1% daily moves on the S&P 500. So, people should understand that type of deal. And right now it's just important. Like, I think there's interesting things that from what I've understood now, starting to trade the 10-year, there's different things that are affecting the 10-year than there was, a year ago or 2 years ago, right? And so I just find that interesting. That being said, it's interesting right now in the 10-year. I mean, I had to nibble a little bit.
Yeah, I think we both will. I think it'll be an interesting week. We've got non-farms coming up on Friday. I don't know if that's, again, I think you and I have spent a lot of time talking about it. Really don't care what the report says. I just could care about what the market does and if it gives us some opportunity. And that will be something that will be fun. And I especially love this before a long holiday because everybody quits early. And what I mean by that is everybody, you get the flurry and by 9:30, everybody's done. And I think I probably told you this story, but if you were standing in that pit at 1:00 in the afternoon on the Friday before a long holiday, you were officially part of what we call Losers Club because you you were there digging yourself out of a hole. And trust me, I spent my fair amount of time in Losers Club too. But usually there'd be 200 guys in the pit, and there'd be like 14 of us, and we're all just shaking our heads, like just trying to get back a little of what we lost. So let's hope this Friday we're both in the Winners Club, not the Losers Club. But Jermal, great to see you, and this has been a wonderful talk. Thank you so much for continuing to take us on this journey into the world of futures.
For sure. Thanks, Pete. Thanks for having me. This is great. We're not going to be in the Losers Club. We're going to be in the Winners Club. That's the plan.
Good enough, man.
Winners.
All right, guys. We'll see you soon in just a little bit. Stay tuned for Splash in the Futures.